So classification of auditing. And the preceding class also we discussed about the vouching and types of vouchers, how the business is going to verify the books of accounts in the auditing procedure in case of the sole trade proprietorship or the partnership firm or the company, and what are the standards of auditing which you have to follow by the auditor when the verification of books of accounts. And in today's class, we are going to discuss about the three important topics which are we can expect in the examination point of view is about the verification and valuation of the assets and also valuation of the liabilities and also verification how these liabilities are going to verify by the auditor. And the last topic is most important, what is audit report and how audit report is going to prepared by the auditor. So these three topics we are going to discuss in detail. So let us discuss about verification and valuation of current assets. So it is one of the major part in the entire assets, generally current assets. It is nothing but which are the assets which are going to liquidate within the stipulated time. Most of the cases only 1 year. That can be verified by the auditor in the books of accounts with the standard auditing procedures and the vouchers which are going to produced by the management for the valuation of the assets. What are the assets? We can categorize the assets in the fixed assets, current assets, and also the fictitious assets, most of the cases tangible and intangible assets. So how these assets are going to be verified by the auditor? Let us discuss one by one. First of all, verification and valuation of individual current assets. Verification and valuation of current assets states that the balance sheets shows true, fair, and view of the financial position of business enterprise. The auditor must satisfy himself the various current assets disclosed in the balance sheet have been valued according to the generally accepted accounting principles, nothing but GAAP. So according to these principles only, the books of accounts has to be followed, and the recording of current assets or the whatever the assets they are mentioning in the books of accounts to be followed, generally accepted accounting principles. So the verification and valuation of current assets states that the balance sheet is showing the true and fair value of the financial position of a business enterprise, either it is partnership firm or the sole proprietorship of in case of the company or the corporate society, whatever the business enterprise it is, it has to be show the true and fair value of the financial position of a business. So let us discuss major current assets which are in the business account is cash, nothing but in the books of account we wrote cash in hand. The main cash and petty cash in hand are to be physically verified at the end of the closing hours of the last day of the financial year. The auditor has to verify carefully while the verifying the cash in hand declaration of the auditor has to be followed of the cash has become the very common technique of committing fraud, because in this regard auditor may be conduct the surprise verification at the time of the during the course of audit, because misrepresentation of cash, misrepresentation of the goods, which may be happened with the physical activities of the current assets. So majorly the cash in hand is the that kind of the asset. So there is a chance of the misrepresentation of cash may be available in the business organization. So that is why the cash and the petty cash in hand are the are to be physically verified at the closing hours of the last day of the financial year. So the auditor has to verify carefully while verifying the cash in hand, because cash in hand and the cash at bank are the both are in the similar nature, but physical cash is available in the business when the in the form of cash in hand. So auditor has to ensure the so many of the techniques to be verified while the cash in hand verification. The cashier is present at the time of the verification. The cashier is to be present at the time of verification that the temporary advances and payments on the suspense accounts are excluded. The cash in hand at the sitting at the compare with the cash book balance, simultaneously a statement is prepared with the details of denominators and the number of currency notes and coins. Both the cashier and auditor staff must sign this statement. Otherwise, the copy of the statement is handed over to the cashier and the auditor may retain the original statement in the future purpose of the organization. In the case of non-agreement of the cash balance, the auditor should demand explanation from the respective cashier on accountant for the non-agreement of the physical cash balance and the cash per balance as per cash book also he has to be verified. And also the petty cash. It is a statement which are preparing for the expenses which are regarding in the business organization for the small expenditure uh, for day-to-day transaction. The stamps and cash in hand has to be slips temporarily advances made to the employees. If any discrepancy, he should get a certificate that effect from the accountant. As far as cash in hand transit is concerned, the auditor should verify this with the help of proper documentary evidence and correspondences. Carrying out a verification of cash at the end of the year by the way surplus to check at any time during the year. The later it will be enable the auditor to detect the if any discrepancies available. The practice of keeping large balance of cash in hand or not the practice should be discouraged from the viewpoint of internal control. To prevent these kind of techniques or these kind of mistakes, difficulties of physically counting the cash, auditor should ask the client to deposit the entire cash balance on balance sheet with a bank. As per the guidelines of ICAI India, the auditor should see whether the duties are segregated among the different persons to authorize cash transaction. So these kind of techniques has to be followed. He should ensure that bank reconciliation is prepared periodically or not. He has to verify these kind of the things in case of the cash in hand. In the same case, cash at bank also available for the purpose of verification and valuation of the cash at bank. Auditor should follow the so many steps compared to the balances shown in the passbook with the shown in the bank column of cash book because these two are the reflecting point in the books of accounts. So bank reconciliation statement is very helpful for in the detection of the verification types of frauds. Therefore, prepare a bank reconciliation statement as on the date of the accounting year as in the current position of the checks drawn by the company, but not yet presented for the payment. The checks deposited by the consent, but not yet clear. These kind of mistakes available in the books of accounts. The auditor shall also carefully verify the post-dated checks issued by the organization before the end of the year, ensure that such checks are not taken into account year under the auditing process. So examine that checks issued for the more than 3 months are treated as unpaid and relative entries are to be reversed. So obtain a certificate of balance of client account as a balance sheet date from the bankers. It is a preventive decision to be taken. And when organization maintain accounts with the more than one account, the auditor should verify all the bank accounts individually. Auditor should obtain separate certificate from the bank in respect of fixed deposit account, current account, and saving account, etc. So scrutinize these fixed deposit receipts in respect of their date of issue, amount, and the rates of interest, date of maturity, etc. And get interest accrued on deposits during the year duly adjusted. If any charge created on the deposit of the uh, deposits made under the any legal requirement, the auditor shall ensure that the fact is disclosed in the balance sheet. Sometime due to legal restriction, one or more banks accounts of the organization may be blocked. In such cases, the auditor shall ensure the fact of disclose of the balance sheet. So these two kinds of cash at bank and cash in hand has to verify by the auditor in this manner. And the next largest current account, current asset is nothing but stock. The stock in trade or the inventories, we simply call it as stock in trade or the inventories, is the life of the blood of a business, nothing but. So therefore, value of the stock in trade has to be properly determined for ascertaining the profit or loss for the year. And also to disclose the true, fair, and financial position of the concern, the inventory stock or trade normally has to include. And generally, stock has to be presented in the books of accounts in the three categories, that is nothing but raw material, work in progress, and finished goods. What is raw material? As we know, raw material from the major input into the production, they are required to carry out the production activities. For example, steel, copper, rubber, the cotton, wool, timber. These kind of the examples in case of the raw material has to taken into the production process and the work in progress. Next, from the raw material into the work in progress, the progress, the work which is in the stage of the stock, which are in the between the raw material and finished goods. It is the middle point where the work in progress is the middle point where raw material and finished goods are to be taken place. It means the total value of the unfinished production are at the end of the each financial period, it has to be in the form of material which have observed carrying amount of the labor, other overheads to reach the manufacturing stages at the time of the counting of the stock of in the case of work in progress. Work in progress should shown in the balance sheet separately and do not in the stock in trade because it has to be still in the process. Uh, in the same case, semi-finished goods. The goods at the semi-finished goods are the finished goods, nothing but we together we can take. And if you want more clarity about the semi-finished goods, you can show in the separate column with the semi-finished good heading. The goods in the semi-finished goods heading, nothing but the date of balance sheet should be valued, the cost of raw material plus reasonable proportion of factory overheads and the production overheads. The auditor should get a certificate from the production manager about the portion of the overheads related to the semi-finished goods. He should also examine the method of absorption of overheads, a percentage of raw material, labor, and volume of the production for a fair allocation. And the next category of the finished goods and semi-finished both are kind of reflecting the same valuation techniques. These are the goods, final goods, nothing but final goods. These are the goods which are ready for the consumers. The stock of finished goods provides a uh, Yet there is a difference between the production and the market. If there is a purchase of finished goods or resale, the valuation should be purchase price or reasonable proportion of direct expenses incurred to them, such freight, duty, and taxes. Finished goods valuation of stock should be lower of cost manufacturing and the market price. Whatever the method of valuation is adopted, the auditor must confirm that valuation of finished goods should never be rate higher than the market price identical goods in the market. And also, in the case of stock valuation, consumer store and spare parts to be verified. Spares name suggests that reflect the additional or extra what required for the ordinary use purely means item kept as a standby. In case of the other item of the same type is lost or broken, they can be used. These are purchased to reduce the idle time of the machineries and the any processing of the manufacturing. So these kind of things has to be verified in a sequential manner. And the loose tools also comes under this category. So this part of the current assets and will be typically found in any balance sheet. It may be produced for the business. There are another definition for the qualifies as the current assets and expected to be used within the next 12 months. In the context of verification, the loose tools, the auditor should obtain a list of loose tools duly authorized by some responsible officers and examine the same. The revaluation of loose tools is also most appropriate method of valuation, and the difference between the cost price and the current price should be treated as depreciation for the loss of any depreciation amount in the profit and loss account. So, what is the auditor duty in the verification? The evaluation of accounting and internal control system. Auditor should study the evaluate the accounting system and controls relating to the inventories. This would facilitate him to determining the nature, timing of the context of the substantial procedure and the carried out by him. The auditor should review the so many of the internal control, internal check to follow the stock in trade, and all the records and amortization, insurance, and the moving stock, examination of the existing of the stock, and these kind of verification has to be followed. And what are the methods of valuation stock? The valuation of stock in trade ordinary in the cost of the market price or the cost price, whichever is less. If the market price is 1,000 and the cost price is 800 only, the 800 has to be taken for the stock in trade because it is showing the less price. So as per the concept of conservatism, concept of conservatism, the stock price has to be recorded whichever is less. Auditor adopt the following any two methods, that is price and pick choose method or global method. Any of the two method can be choose for the valuation of the stock in trade. What is individual or pick or the choose method? According to the individual or pick method, the lower of the cost of market price basis in the respect of each individual items and the stock, the total same has to be the inventory. In the opposite of global method, the first of all, the cost of all items determined and aggregated. Then the market price of all items has to be ascertained and aggregated. The lower of the two valuation of the method has to taken whichever is showing less amount. In generally, what are the methods of calculating of the cost price? What are the methods? Generally, the material or the stock issued on the basis of FIFO, LIFO, and the weighted average method, unit cost method, actual cost method. These are the so many base stock method, highest of HIFO, highest in first out method, average cost method. In that average cost, simple average, weighted average, and standard cost method. So many methods of issuing of the material has been followed in the verification of books of accounts. The auditor has to verify which kind of method has been followed by the accountant, as to the same method has to be followed by the auditor at the time of verification of books of accounts. So this kind of verification has to be followed in the case of stock. And in the same way, the dates are the sundry data, the book debts we can call simply sundry debtors. So the sundry debtors fall in the category of current assets. The task of verifying this asset would be reduced largely in case of there is an efficient internal check system for the regarding the sales, the writing of the sales ledger. According to the Companies Act 2013, the books of accounts, the debts should be recorded and the debts considered the good in respect of which the company is full secured, and the debt considered good for the company holds no security other than the debt's personal security. In case the debts considered doubtful or bad to be recorded in the books of account, the objective of the verification of the case, the books debt ascertain the correctness or accuracy of the amount of books debts, the validity, and also in the same way confirmation of claims against the uh, recorded debts, the collectively determination of realized value, and the appropriate disclosure of the accordings with the legal provisions and the professional records. So these are the uh, bad debts about business organization has to be verified by the auditor. So these kind of techniques has to be followed in case of current assets. And what about the intangible assets? The intangible assets are the same, those assets which do not have their form or physical existence. However, the part of businesses appear in the balance sheet. Like other assets, the virtue of their utility of the business, generally the intangible assets are can be we say the books of accounts, goodwill, patent rights, copyrights, or the trademark, some of the examples of the intangible asset. The cost of intangible or the fixed asset amortized over their usage of life. The intangible assets is defined by the internal accounting standard board and identify identifiable non-monetary asset without physical substance. The knowledge, the brand, trademark, and the goodwill comes under this category. So this has to be verified by the auditor with the time of auditing process. And what is the uh, same statement about the fixed assets? According according to Indian Accounting Standard 10, fixed assets comes under the issued by the AICAI. The cost of item fixed assets apply the purchase price, including import duties and other non-refundable taxes, are the any of the directly attributed cost to bring the assets working condition intended to use. So these kind of expenses has to be followed by the time of valuation of fixed assets. Uh, In the case of accuracy of authenticity of financial statements, the mainly depending on the correctness of the valuation of business assets, because of otherwise the balance sheet will not truly and fairly present the financial position of the business and the profit and loss account, the results of the operation. Thus, it is paramount importance of the before turning into the opinion of the financial statement. The auditor should fully assure himself that the values placed on the business assets are fairly reasonable and accordance with the acceptance of the commercial principle of the statutory requirement, if any, that not in a influenced by personal bias, self-interest, and careless dishonesty. So he has to verify in detail about the proper which system he has to involve in the internal control procedure. However, the auditor's responsibility as the valuation assets does not end with the merely securing the certificate of valuation from the experts, including the officials of the clients. His duty is to take all the responsible steps to the exercise due care of ensure that the valuation of assets shown in the certificate does not intended to represent a true and fair value. Hence, he is required to ascertain that valuation has been done conformity with the legal and professional standards as to generally accepted accounting principles. That the principles and practice governing valuation of assets have been consistently followed. If he does not exercise these kind of due course, the skill of the matter of valuation, or if he falsely represent that he has performed the necessary operations in the connections, he may be held guilty in the negligence and the liability for the damages. So he has to be followed. And the auditor may be held liable for the incorrect valuation if he established that the matter within the special field of competence that the valuation their failure in is part of the exercise, the quality of judgment reasonably associated with the person in skilled profession. So revaluation of fixed asset, though there is no conscious about the question of providing funds for replacement of fixed asset, the auditor should advise the clients to do so either by the periodical revaluation fixed assets or by setting aside appropriate sum out of the profits to reverse the specialty created for the purpose. A revaluation means a revision of the book's value of the capital assets in accordance with the proper appraisal of such assets. So these kind of techniques has to be followed by the auditor. And the verification of individual stock, what is freehold land and the buildings, leasehold or the ownership flats, which has to be verified by the auditor at the time of books of accounts. As we know, furniture and plant and machinery has to be followed. Next step is about next topic is about verification of the liability. Let me share this a photo with you. Okay. This is about verification of liabilities by the auditor. Okay, what are the liabilities? So let us discuss about one by one. Liabilities are the legal obligation of business organization to the third parties. It is in the form of capital, the debentures, and the long-term loans, or the suppliers against the goods and expenses, or the contingent liabilities, etc. As per these classification, we are going to discuss one by one. Verification of the liabilities is important as a verification of asset. The same as the assets, how the assets are important for the business organization, the same way liabilities also important. If liabilities are not properly verified and valued, the balance sheet will not reveal a true and fair view of the state of affairs of a business concern. The main objective of verifying liabilities is to ensure that the liabilities are properly disclosed, valued, classified, and presented in the balance sheet. So the diagram which I have shared with you are the various types of classification of liabilities. What are the various classification of verification of liabilities is the first step is capital, debentures, long-term loans, current liabilities, and contingent liabilities. These are the different types of liabilities which are we are going to discuss in detail about this. So let us discuss about capital. Under the capital, we have partnership firm, company, and the capital reserves and surplus. So verification of capital, the amount invested by the owner in a business concern is called capital. Nothing but the amount invested by the business owner in the business is nothing but capital. The owner may be sole proprietor or the partners or the shareholders. Whatever the position he has, the owner having the proprietor, means sole proprietor and the partner or the shareholder, group of shareholders. It is an internal liability of the business concern that auditor is required to verify the genuineness and correctness of the balance sheet. So, what is in the case of partnership firm? Okay. What is in case of the partnership firm? The auditor should take into consideration of the so many steps while the verifying of the capitals in the uh, partnership firm. He has to verify the first the partnership deed. The auditor should verify the partnership deed to find out original capital contributed by each partner and the rate of interest payable on that uh, invested capital. So the auditor should verify the partnership deed. Why partnership he has to verify? The partnership deed contains the details of the partnership, the what are the agreements they have agreed for the conduct of business organization, what are the interest rates they have to be follow in the during the business, and what is the limit of the capital and how what are the drawings limit and how the interest on drawings has to be calculated. These kind of total agreements which are recording in a paper, that is nothing but partnership deed. And where so the auditor should verify these kind of partnership deed to find out the original capital contributed by each partner and the rate of interest payable on that capital. And also next after that partnership deed, verify the capital accounts. He has to verify the all the transactions affecting on the capital accounts of a partner. The capital accounts are which are prepared for the uh, to distribute the profits and to distribute the interest on drawing, to distribute the interest on capital and distribute the net profit, uh, how much the profit they are getting and how much to it has to divide according to their proportionate share. It will be reflecting the capital accounts. So he should verify all the transactions affecting in the capital accounts of the partner. And also he has to examine the books of accounts. He should examine the cash book, passbook, and withdrawals of the partners. So these kind of books has to verify in case of the partnership firm. And the second second business kind is company. It is about second is company. While verifying the capital of a company, the auditor should verify the share capital and the level of reserves and surplus maintained by the company. How this company has to be followed and what is share capital. Generally, we are using the term capital and also share capital. Share capital means the capital raised by issue of shares. It is the amount invested by the shareholders toward the face value of the shares are collectively known as the share capital. And it is having so many types, nothing but equity share capital, preference share capital, and the debentures, and so on. Different types of capital uh, they can raise the funds from the general public or the financial institutions also. In that equity share capital has to be uh, categorized in so many types. Nothing but authorized capital, issued capital, and a subscribed capital, called up capital, and paid up capital. These are the kinds of uh, equity share capital. Nothing but authorized capital. We discussed in our previous class about this also. Uh, it is the maximum amount of capital. What is authorized capital is the maximum amount of capital uh, a company is authorized to raise and stated in the memorandum of association. It can be called as a registered capital and issued capital, how much the capital is issued and subscribed out of that issued capital, how much of the capital has been subscribed, and out of the subscribed capital, how much amount of the capital has been called up, called up capital, how much amount of the capital is paid by the shareholders. So these are the classification of the equity share capital. These kind of things has to be verified by the auditor. So the auditor's role is verifying the share capital, the verifying of the memorandum of association or the register of members. In case of the first auditor, the auditor should check the memorandum of association, list of the shareholders, register of the memorandum of association of the capital, and what are the voucher entries. He should examine the passbook and the cash book and the minute book of the directors in order to find out the number of shares issued and different types of shares issued and the amount received on each shares. He has to verify these kind of books and also compliance with the provisions of the uh, Companies Act. In case of the subsequent audit, the auditor should ensure that share capital is in the same at the end of the last year. If he finds that the capital stands altered by fresh issue of shares, the auditor should ensure that relevant provisions of the Companies Act have to be complied with. And the disclosure of the balance sheet, he should ensure that authorized capital of each class of issued, subscribed, and the capital has been shown in the separately in the balance sheet. Examining of the right of the shareholders, he should examine the rights attached to the various shares in the articles of the association of the companies, and RBI approval letter and the transfer of the capital funds he has to verify. And in the same way, reserves and surplus is the portion, this kind of things, reserves and surplus are the portion of the current profits of accumulated profits which are not distributed as a dividend. And undistributed profits, nothing but kept separate for the purpose of meeting some known or unknown liabilities to fulfillment of the future needs. So auditor has to verify the memorandum of association and register of the members and the voucher entries and the complaints of provisions of the Companies Act, disclosure in the balance sheet, examine the right of shareholders and issue premium, issue of the shares of consideration other than the cash, RBI approval, and the transfer of capital. These kind of forms he has to verify. And in the same way, debentures. The next part is about the in case of how the valuation of the auditing has to be verified in the debenture. Debentures means it is a document. It is issued by a company to raise finance. The same case of the capital, the debenture also the same kind of document issued by the auditor, sorry, issued by the company to raise funds, other nothing but finance. It is acknowledgement of debt, which is uh, given under the common seal of the company. It is given by the just by the company with the common seal, or the debentures also having different types: registered debentures, bearer debentures, secured debentures, unsecured debenture, and we know redeemable debentures or irredeemable debentures, convertible and the non-convertible debentures. These kind of debentures available in the books of accounts. Auditor has to verify which type of debentures issued by the company and which type of debenture they are paying interest on this kind of debt. So he has verified the borrowing powers, he has to verify the terms of issue, and he has to verify the uh, examine the debenture trust deed, redemption of debentures, issues of premium and discount, and the compare the registered charges and register the debenture holders. It is about the debenture. Next, in case of uh, how auditor is going to verify the long-term liabilities, long-term loans, nothing but long-term loans. The loans are borrowings of a concern may be either secured or unsecured, maybe for the short or long period. What is auditor duty? The loan which are borrowing of a concern may be either secured or unsecured. So he has to verify whatever the loan it is. Auditor duty is to verify the loan account of the books of accounts, long-term loans. The auditor, while verifying the loan, he has the verify loan agreement. He has to verify the loan agreement. He has to inquire the purpose of loan. He has to verify the examination of the borrowing powers and the disclosure in the balance sheet. And he has to obtain a confirmation letter. So these kind of books he has to verify in the accounting process for the verification of auditing. The auditor should verify the loan agreement refers to the correspondence of the getting the loan, and he should inquire the purpose of the which loan has been raised and also confirm that loan raised are being utilized in the specific purpose of the which he has been obtained. And he should examine the borrowing powers of the company referring to the memorandum of association or the articles association of the company. And he should also verify that secured loans are shown separately from the unsecured loans. If any interest due but not paid is treated as a current liability in the balance sheet. So these kind of verification he has to follow. He should obtain confirmation letter from the parties who have advanced loans and should verify the balances with the books of accounts. And already we discussed about the current liabilities in the previous class. Current liabilities we discussed about in the just previous slides. Current creditors, bills payable, overdraft, and outstanding creditors. How sundry creditors have been formed, and how bills payable is getting by the bills issued by the so many outside persons, and how much time due for the payment of the bills, and how these are going to discounted in the banks, and how much amount and what is the duration of this kind of uh, payments you have to pay, and bank overdraft and outstanding expenses we have to pay in the course of business organization. And these kind of entries has to be verified by the auditor when the verification of books of accounts for the verification of the current liabilities. And the last is about current liabilities, sorry, contingent liabilities. The contingent liabilities are those liabilities which may or may not arise in the future for payment. The auditor should ensure that all known or unknown liabilities have been accounted in the books of accounts have to be shown in the balance sheet. So it is a combination of list of all the liabilities and all the assets. So he has to verify. What is the contingent liabilities? Liabilities on bills receivable, discounted and not matured, and liability on account of partly paid bills or liabilities on arrears, dividends, cumulative preference shares, liability under a guarantee, liability for a penalty under the forward contracts, liability that arise on account of litigation in respect of labor suit, trademarks, copyright, etc. So how auditor is going to verify these kind of liabilities of general contingent liabilities? He has to ensure creation of adequate provision. IATA should ensure that proper provisions which have been made for a certain liability. For example, liability which arise on account of litigation. If he not satisfied, the fact should be stated in the reports. Our next topic is about the report only, and the disclosure in the balance sheet. In respect of certain liabilities for which no provision has been made in the books, for example, bills receivable which have been discounted and arrears of accumulated fixed dividends, etc. The auditor should verify that such liabilities disclosed as a footnote in the balance sheet. So these kind of the contingent liabilities also verified by the auditor. So verification of liabilities, nothing but capital debentures, long-term loans, current liabilities, and contingent liabilities. Sorry, there is a technical issue. Okay, we discussed about valuation and verification of assets and also liabilities, and our topic is audit report. What is audit report and how audit report is prepared by the auditor after verification of these kind of all the auditing processes. So audit report is a formal document prepared by an independent external auditor providing an expert opinion of the company's financial statements. Why our auditor has been appointed for the verification of books of accounts or the examination of the books of accounts, which are with the help of the proper watching system, proper internal control, and proper evidence of the books of accounts. He has to verify each and every record of the business transactions. So after the verification and after the valuation of these kind of the all the business transaction, he has to prepare a report. It is a formal document prepared by an independent external auditor, providing an expert opinion on the company's financial statements. So auditor ensure that financial statements of the company, nothing but balance sheet or the uh, profit and loss account and the trading account, so which comply with the generally accepted accounting principles, nothing but GAAP, are the free from the material misattachment. This audit process mandated by the Companies Act for entitling the including private limited or the public or one person companies or the nothing but offer banks, investors, creditors, and the regulators bodies for the true and fair view of the company's financial health. A report submitted by the chartered accountant is essential for the company complaints, and it's often including the annual reports. Annual reports are going to release by the each and every company has to include this audit report and the annual report. So these are kind of report is audit report is to be developed. How this audit report is going to affect in the auditing process, we can discuss one by one. An audit report is official opinion by an internal or external audit of a company on the financial statements. It says whether the financial statements like the balance sheet or income statement accurately reflecting the company's financial health. This is important for investors, creditors, or other who rely on the financial statement to make the decisions. The report is based on the auditor's examination of the company financial records. Ideally, the report gives the clear opinion, meaning that statements are accurate, but it could also find issues and gives a qualified or even negative opinion. On completion of the audit, the auditor provides an audit report which answer the some questions. What are the questions? Whether the balance sheet and the profit and loss account of a company give a true and fair view of the state of the affairs of the company. Whether the company is maintained the proper books of accounts as required by the law. Whether the accounts are prepared as per the accounting standards issued by the ICAI, whether the company has sufficient measures and internal control to safeguard the fixed assets at the inventory, whether the company has sufficient internal control uh, uh, capability on the size of the company, and whether the company has default on any loan or the banks of the financial institutions, and whether these are the any instances of fraud in the company. So whether the related party of the transaction are illegally they are recorded. So these kind of questions, the solution is audit report. So five major benefits of audit report are we are going to discuss what are the five major benefits. It is increase the trust and transparency. The audit report, an independent auditor's opinion on the accuracy of the financial statements fosters the trust transparency between the companies uh, and its stakeholders. Investors gain confidence and reported financial performance before making investment decisions. Similarly, creditors can assess the financial stability of the company when considering the loans or any credit. Uh, so, informed decisions. So, this is increase the trust and the transparency of the audit report. And also, the second major important benefit is about informed decision making. Financial statements are primarily source of information for the stakeholders to understand a company's financial position and profitability. The audit report assessment of these statements helps stakeholders make informed decisions. For instance, mm, potential investor can use the report to evaluate the company's risk profile and growth of the growth of a company. So informed decision also can be possible with this audit report and regulatory compliance. Many companies are required by law to undergo audits and submit audited financial statement to regulatory bodies. The audit report helps ensure compliance with the accounting standards and regulatories to reducing the risk of the penalties or legal issues. And also, it is important in the point of identification of potential issues. The audit process can discover the weakness of the company's internal control or accounting practices. The audit report can highlight these areas for management to address improving overall financial management and risk mitigation. And the benchmarking and comparison. Audited financial statement allow the comparison with the peers for companies to competitive industries. Investors and analysts can use these reports to assess the company's relative performance and financial health within the industry. So these kind of major benefits are available for with the audit report. And what are the types of audit report? We already discussed in the previous classes, but we have to discuss in detail for the examination point of view. An audit report is a formal document issued by an auditor expressing their professional opinion on the fairness of accuracy of the company financial statements. There are four main types of audit reports, such as uh, conveying the different level of assurance to the stakeholders. So, what are the main four types of audit reports? Let us discuss one by one. First one is about unqualified or clear opinion. Unqualified or clear opinion. The unqualified opinion, often referred to as a clear opinion, is the most favorable audit report. It indicates that the financial statement present a fair and accurate representation of the company's financial position in all the material aspects. If changes are the reservations are made to an unqualified reports, these generally fall under the two categories: gap, departure, or scope limitations. So unqualified or the clean report is giving these kind of two uh, subcategories are gap, departure, or scope limitation. And the second audit report is about qualified opinion. Unqualified or clear opinion is about first audit report, and second is about qualified opinion. A qualified opinion indicates that the auditor encountered some issues during the audit. There are too many situations where this might occur, that is, limited material misattachments or the insufficient audit evidence. Limited material misattachments, the final statement contains errors or misattachments, but they are not the proactive the statement of the don't significantly affect the overall financial picture. The specific areas with the issues with the highlight the report, allowing the companies to address them. And also, second reason is about insufficient audit evidence. The auditor may not have gathered enough the evidence to definitely form an opinion of the financial statement. While there might be a potential misattachment, their impact is unclear. So that is why this is called qualified opinion. And third report is about adverse opinion. An adverse opinion is the most severe audit report indicating that the financial statement contains both material or uh, misattachments. This type of report can have the serious consequences for a company, including damage to the reputation and the possible legal problems. Adverse opinions may arise from the errors occurred unintentionally or due of the fraudulent activities. If illegal actions are covered, uh, the corporate officers may face criminal charges, if any, they have to be imposed. And the investors and regulators also will reject the company's financial statements unless corrective action is taken. So the company may need to undergo the re-audit after making corrections. So this is also a lengthy process. And also disclaimer of opinion. An auditor issue a disclaimer of opinion when they are unable to form an opinion on the company's financial statement. This can occur of the several reasons. The auditor was unable to obtain sufficient data or the evidence from the support of their opinion. The auditor questions were not answered satisfactorily. The potential effects of undetected misattachment could be both material or in misopinion. So this often happens while the auditor is denied access to key financial information or if they cannot remain impartial. So a disclaimer opinion suggests that company financial health cannot be determined with the certainty. So these are the different types of the audit reports, and majorly seven essential elements of the audit report include title of the audit report, introduction of the paragraph, of the scope of the paragraph, executive summary of the paragraph, and opinion paragraph of the auditor, and the name of the auditor, signature of the auditor. These kind of essential information to be included in the audit report. So it is about audit report. You may expect this kind of questions in the your examination point of view. So in today class, we discussed about verification and valuation of assets and the valuation of the liabilities and the types, what is audit report and what are the types of audit. So with this, we are going to conclude our subject about auditing. I'm wishing you all the best for your examination point of view. Be prepared and be confident and write well. You will definitely will get a good score. Congratulations and all the best. Thank you.